Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is June 9th and this is a weekly markets update. Let's have a look at the news of week 23 and see what are the next trends. The urea market was rather quiet last week, before the Indian tender closure that will happen later this week. As usually, there are a lot of speculations regarding which producers will mostly participate and what will be the price level. For now, it seems like there will be no surprise, and Middle East and Russian producers will dominate in the tender, both having significant amounts available for July. Price level circulating is $400 CFR West Coast, at least, maybe even more or a bit less. The question is how many tons India will be able to secure, targeting 1.5 million. The market expects that with Chinese volumes being out of the tender, there will be barely 1 million tons potentially available, or even less than that. If the volume secured turns out to be significantly less than 1 million, we might see global price level easing immediately in the second half of June. Otherwise, current plus-minus price level might be preserved further in July until more demand emerges in July-August from other countries. In China, export inspections continue, and the main export flow is expected as of end June into July. Last week, producers tried to push the current market level higher in front of the tender, at least with small sales. Egyptian producers sold the highest at $407 FOB, but only for a small lot of 3,000 tons. Algerian producer reached $410 for sale to Europe. But in general, European demand remained very weak due to off-season. Ethiopian ABC came out with additional tender last week for 260,000 tons of urea for loading during end June to early August, in 5 lots. The tender will be closed tomorrow. Offers from Middle East producers increased by $5 to $380 to $85 FOB, but activity was limited due to Eid holidays and preparations for the tender. Several Iranian producers conducted sales tenders last week with minimum target price of $350 FOB, but bids appeared to be lower than that, so no business confirmed. In Indonesia, Pusri finalized its sales tender for 2 small lots of prilled urea at $370 FOB. Meanwhile, demand in the Southeast Asian markets continued firming, and prices as well, specifically in Thailand. Dangote sold 1 of 2 cargoes offered to the market at $393 FOB. The product will likely to go to Latin America. Demand in Brazil is still weak, but there was some uptick last week. The recent CFR level was marked between $390 to $405. Meantime, regular contract shipments continue to flow. In the US, purchase window is closed now, and prices continued to deteriorate. This year, due to hiccups with imports and low affordability, total consumption is expected to be lower versus previous year. Prices at NOLA dropped by $30 more last week to the level of $360 per short ton and even lower. Paper values corrected slightly downwards for July and August across benchmarks, amid news about continuing export activity from China. Egypt FOB future price for July and August dropped by $10 to the low 390s average. Arab Gulf FOB future price just slightly corrected downwards, as the market expects producers from the region to be the key suppliers in the Indian tender. Brazil CFR corrected by $5 for all 3 months. NOLA FOB lost another $10 for June and dropped to the average of 360 in July and August. Anyway, the market still doesn't expect any dramatic downward price correction in summer. Ammonium sulfate market was quiet again last week. Chinese AMSOL values held at the similar level of $150 to $55 FOB for crystal product and $160 to $70 FOB for granular. There were no fresh tenders announced by Chinese producers. Demand in key markets also is subdued. In Brazil, offers stayed around $180 CFR for granular product with very limited sales happening. In Philippines, a small tender for 8 to 10,000 tons of AMSUL closed on Friday, results to be available this week. Other than that, there were no significant product movements globally. The nitrates market continues to be bullish. The main news of last week was a purchase tender announced by Tunisian GCT for 70,000 tons of ammonium nitrate to be supplied during August to and October. The tender will close on Monday next week. Most likely this tender will be supplied as usually by producers from Baltics, tightening supply from the region. Baltic prices already climbed to the level of $225 FOB last week. In Europe, nitrates prices for the next campaign continue to increase on the back of the firm urea price. CF in the UK issued new price for deliveries June through September at £325 CPT, which is higher versus a year ago. Yara raised its August price for both ammonium nitrate and CAN by €10 just in 1 week after last price increase. Same did LAT nitrogen, the price announced by €10 to €15 for August delivery. Both companies indicated that product amounts are limited, so perhaps we will see more price increases. In UAN segment, activity in Europe was very limited. Prices remained largely unchanged. At the same time, in the US, UAN price in NOLA even increased a bit to the level of $340 to $60 FOB per short ton, despite urea price softening. This year, due to production outages and much lower import volumes, price at the end of the season keeps high on the back of the limited supply. Top-dress demand is still expected later in June, so price perhaps will keep at current level for a couple of more weeks. Ammonia market was eagerly waiting for the settlement of June price in Tampa, and no surprise, it was settled last week at $392 CFR, which is $23 lower versus May. Sales to Europe last week were heard around 35,000 tons at undisclosed price level. But rumors put latest CFR deals at around $400, unchanged from the previous ones. Supply west of Suez remains robust with no information about any gas curtailments or maintenance. Almost the only uncertainty is related to the next shipment from Gulf Coast ammonia plant in the US that seems like will not happen before Q3. East of Suez, there was an uptick in inquiries and shipments to China last week, while there were no new business for India. Supply from the Middle East continues to be ample, even despite curtailments in Ma'aden. So, market evaluates current situation as balanced, while more price decrease might happen in the West. In the phosphates market, prices continue increasing despite affordability issues, and market players expect prices to firm further. In India, fresh DAP sales were conducted at the level $19 higher versus previous ones, and $757 CFR. This was the sales of 50,000 tons of OCP to the latest tender. Also, GPMC confirmed its sales tender result in the mid-750s FOB, which most likely will also go to India, meaning CFR level higher than $770. The CFR level jumped by more than $130 in just 3 months since March. China supply continues to be the factor stimulating global price increase. Last week, the higher floor for DAP FOB price was set at the level of $700, and export quotas are even lower than market expected. Spot prices surged to $715 to $25 FOB, while the volumes for June seem to be sold out. Only July volumes are available. OCP sold small lots to the Western and Eastern Europe in the range between $725 to $45 FOB. Meanwhile, Ethiopian ABC came out with a new additional tender for supply of 170,000 tons of DAP. Tender will close this week. Of course, this inquiry further tightens the market and supports the bullish trend for June onwards. In Latin America, prices for MAP also firmed, but not that dramatically as for DAP in other regions, only by $5. Demand in Brazil is almost non-existing. No fresh deals were registered. At the same time, business happened in Argentina at the level of $760 plus CFR. OCP reported sales of 30,000 tons of MAP for July loading at as high level as $790 to $95 CFR, likely also to Argentina. Activity in NOLA was limited, with prices remaining largely unchanged. DAP assessed at $700 FOB per short ton. Moving to the fundamentals. European natural gas futures climbed above 36 euros per megawatt hour as supply from Norway dropped due to planned maintenance at the Kolsnes processing plant. Norway supplied around a third of the EU's gas imports last year, so any disruption has a noticeable impact. Traders are working to rebuild storage levels ahead of winter, while keeping an eye on geopolitical tensions, including ongoing US trade tariffs and war in Ukraine. However, weaker demand for gas in China is helping redirect more LNG to Europe, slightly easing supply pressures for the summer. US natural gas futures increased by 8% to above $3.75 per MMBTU, driven mainly by lower production. Output averaged 104 billion cubic feet per day so far in June, down a record 106 billion in March. Forecasts for warmer than usual weather for mid-June also supported prices by raising demand expectations. Meanwhile, gas flows to the major US LNG export terminals declined in early June, largely due to regular seasonal maintenance. Agricultural commodities future prices came back to growth trajectory last week. Wheat futures rose to above $5.55 per bushel, driven by concerns over escalating conflict between Ukraine and Russia, as well as dryness in part of China's wheat belt, prompting a wave of short covering. Support also came from a weaker dollar, which made US grains more attractive to foreign buyers. Traders were reacting to news that China's Shaanxi and Henan provinces were experiencing hot, dry conditions that could potentially damage wheat harvests. Additional upward pressure came from fears over disruptions to Black Sea grain trade. Despite the rally, market participants remain uncertain about whether China would increase imports due to its existing wheat reserves. Corn futures increased slightly, reflecting cautious strength of market expectations. Export sales reported a rebound in old crop shipments, led by Mexico and South Korea, although new crop bookings lagged behind. Despite strong April corn exports, up 21% year-over-year, the looming pressure from Brazil's emerging supply and Argentina's progressing harvest is holding prices in check. US ethanol exports showed a decline from last year's highs, further complicating the bullish outlook. Nevertheless, the corn market is entirely focused on current growing conditions. Planting progress is right in line with normal, and plenty of precipitation has fallen last week on the newly planted crop. As a result, production concerns are low and have given fund managers enough confidence to stay on the short side of the market. Soybean futures climbed above $10.5 per bushel, rebounding from a one-month low last week, as supply concerns and renewed buying tightened availability. War in Ukraine escalation raised export disruption fears. In the US, planting is ahead of average, but shifting weather, rains followed by dryness, could hurt yields. Brazilian 24-25 crop forecast was increased to 129 million tons, supporting medium-term supply, though early planting in Mato Grosso do Sul and Paraná was hampered by rain and frost, leaving near-term yields at risk. Meanwhile, expectations of US-China talks and Vietnam's $2 billion purchase pact bolstered export prospects. Moving to the shipping industry. Containerized freight index gained another 150 points last week, and the reasons are the same as a week ago. Pause on import tariffs for China and expected China-US trade discussion expected this week. Freight rates from Shanghai to Los Angeles surged by 57% in the past week. Spot rates to New York by 39%. Freight rates from Shanghai to Rotterdam and Genoa have also risen by more than 30%. However, market experts expect that supply-demand balance to weaken again in the second half of the year, which will cause spot rates to decline. The Baltic Exchange Dry Index showed another week of significant gains. The Capesize market enjoyed a strong upward trajectory driven by consistent gains in the Pacific and mounting support in both South Brazil and the North Atlantic. The Panamax market also wrapped up a notably active week with solid gains, particularly driven by renewed strength in the Atlantic. At the same time, for Ultra Supermax segment, it was another challenging week, with rates in both the Atlantic and Pacific regions under continued downward pressure. In the continent and Mediterranean, sentiment remained largely positional, and the Asian market also experienced a sluggish week. In Handysize segment, the market delivered a mixed performance across the regions, with overall sentiment remaining flat. In the continent and Mediterranean, as well as in Asia, market fundamentals stayed soft, while the South Atlantic and US Gulf markets maintained a steady pace, supported by stable tonnage levels and pockets of fresh demand. To sum up, market eagerly awaits closure of urea Indian tender later this week that will show the direction to the market for summer period. As for now, it doesn't look like there will be a significant downward correction in Q3, even with Chinese supply coming back to the international scene. Indian tender, additional Ethiopian tender, demand from Latin America that will emerge at its full later in Q3 is supporting market sentiment. At the same time, steady supply from Egyptian producers and more supply expected in the Black Sea, as well as, of course, more Chinese tons, might change the sentiment later in June and July. Nitrates prices continued to climb across European markets, supported with demand from the buyers, despite affordability hitting the lowest levels. Ammonium sulfate prices hovered at the similar level versus previous weeks, but general bullish sentiment might support the level later during Q3. Phosphates prices reached another record last week, even again, despite the worst affordability in 3 years at least. Supply continued to be tight and demand steady in India, Ethiopia, and some other markets. There is no price ceiling approaching anytime soon, as market participants see it. New contract ammonia price in Tampa confirmed bearish sentiment generally in the market, but price deterioration east of Suez has stopped for now. Gas price, both in Europe and US, climbed mainly due to production decrease caused by maintenance. Agricultural commodities future prices also showed positive dynamics amid concerns regarding supply from the Black Sea with Ukraine-Russia war escalation, as well as weather-related risks weighing on harvest expectations. Container shipping prices again increased significantly on the back of positive expectations regarding US-China trade negotiations. Bulk shipping activity was also positive, supported mainly by strong activity in Capesize and Panamax segments. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.